Hello and welcome to Integrated Capital Management's second quarter 2025 Market Insights webcast. My name is Pete Seiler. I'm a part of our business development team here at iCM, and I'll be joined in a moment by iCM's Chief Investment Officer, Mike Pisciotti, and the Director of Investments, Ryan Lehman. Before we jump into our material for today, I'd like to take a moment on just a few housekeeping items. First, this webcast is being recorded. Therefore, all participants are on mute. The replay of this webcast will be sent as a follow-up to all registrants, as well as being posted on our YouTube channel, along with our other great content, such as the weekly Markets in a Minute and our monthly Mic'd Up with ICM. If you have questions during this webcast, please submit them through the Q&A option on your user dashboard. We'll address those questions as well as the questions that were submitted to us in advance of this webcast at the conclusion of Mike and Ryan's prepared remarks. If you have any additional questions for our team, please do not hesitate to reach out to us at info@icm-invest.com, and a member of our team will be in contact with you. Without further delay, I want to welcome in Mike Pisciotti. Mike, the floor is yours.
Thanks, Pete, and welcome everyone to our second quarter 2025 Market Insights presentation. As Pete mentioned, I'm Mike Pisciotti. I'm the Chief Investment Officer for the firm, and I'll be joined shortly by our Director of Investments, Ryan Lehman, who, along with Pete and I, will be your hosts for today's presentation. So after a second consecutive year of 20+% equity market gains, the early going of 2025 really kind of marked the return of I guess what we could call an old friend that's been gone for some time, that being volatility. So from its peak on February 19th, U.S. stocks as measured by the S&P 500 have declined by just over 17%. Not a huge sum in the larger scope of things, but certainly a large amount in such a short period. In fact, in those 33 trading days, that represents about a 3.25 standard deviation event, or a probability of less than 1%. So said differently, only 1% of all 33-day trading periods back to 1970 have actually been worse than the last, our most recent 33 trading day period. So significant amount of volatility in really such a short period. So while some have really kind of been quick to point out tariffs as the driving force, I would argue that the problem begins long before that and is the result of being priced to perfection, right? We've talked about this many times recently. When something's priced to perfection, anything other than a perfect outcome can upset the apple cart. So for U.S. stocks, we ended 2024 priced at 34 times 10-year earnings, which is in the 96th percentile of most expensive markets on record. And with the consensus expecting 20+% earnings growth in 2025. So anything less than that just is not going to justify that multiple. So in this case, it appears to be a variety of factors have at least shaken the resolve of equity investors so far in 2025, those being tariffs, reduced government spending, immigration reform, really the keys to President Trump's early days back in office. So over the course of the next 40 minutes, we're going to address each of these items and their impact on the economy and corresponding investment implications. So our goal here, folks, is really just to call balls and strikes on this in a nonpartisan manner. I'm then going to turn it over. I'll finish up with a brief bond market recap before really turning it over to Ryan to run us through equity markets, including some of the detail on what's driving the really solid international returns that we saw during the first marking period of 2025. And of course, we'll take some questions at the end. So with that, let's just jump right in, and we'll start with a few economic data points before transitioning into fixed income. So to kick us off, let me start with a bit of a refresher on macroeconomics and two important drivers of economic growth, those being growth of the labor force and productivity growth. So in fact, these two variables explain about 95% of real GDP growth. So think about it. You employ more people, they spend more money. If you make them more productive, that's good for profits and allows for wages to expand without creating inflation. Also really resulting in more money being spent. So a climate of a growing labor force and high productivity growth is a pretty good recipe for strong real GDP growth. So here we could see this really at work with the blue shaded area being really real GDP, the orange line representing productivity growth, and the blue line representing the growth of the labor force. Now, both variables, while remaining positive, started to trend downward about 1 year ago in March of 2024. So the result has been a deceleration of economic growth. Now, looking forward, both of these can be impacted directly or indirectly by changing immigration patterns and stand to be a bit of a headwind, at least in the near term. So, how does this work? According to the Bureau of Labor and Statistics, the labor force includes all people aged 16 and older who are either employed or unemployed but actively seeking work. So, this actually includes legally admitted immigrants as well as undocumented immigrants and is collected via the current population survey. So while technically the BLS survey does not exclude individuals based on their immigration status, I would suspect that many who are here illegally do not actually answer the survey. So as a result, the labor force is likely understated, but that contribution is captured as enhanced productivity. So that is that two workers may be contributing to output, but only one is counted, resulting in the perception of greater productivity. So why does this matter? So as previously mentioned, enhanced productivity allows wages to rise without creating inflation. Greater wages lead to more money in circulation and greater spending, which is a positive for economic growth. Likewise, more people working and earning a wage leads to the same outcome. Legal or illegal, those wages are being spent on goods and services and recirculated into the economy. So, therefore, and perhaps surprisingly, a change in the influx of illegal immigrants will likely either reduce or slow the growth rate of the labor force, assuming that they were in fact counted by the BLS survey in the first place. Otherwise, their efforts of future illegals will not be counted as enhanced productivity. The consequence being, once again, kind of downward pressure on economic growth. Now, again, I'm going to give my disclaimer. It bears repeating. I'm not advocating for or against these policies. I'm simply evaluating really the outcome here. And in this case, while we may save some resources, the consequence of that, or for that matter, the reduction in any reduction in productivity or labor force growth rate, is a negative impact on economic growth, at least in the short run. So, and that's what we're showing here on this slide. Here, what we're comparing is total border crossings against total growth of the labor force to provide some perspective about how large these things are. So if even if a fraction of the illegals among those counted in the labor force growth rate, the reduction in workers could actually have a meaningful impact on real GDP growth, at least in the short run. So the second leg of the stool during the early Trump presidency is a reduction in government spending. So based on our research of recent years, the US prior to COVID and excluding crisis years ran fiscal deficits of right around 4% of GDP. So that's what's shown in the panel on the left side of this slide. So part of this is due to the fact that the US dollar is the global reserve currency, which requires a certain amount of debt issuance to manage and maintain a stable currency relative to the rest of the globe. So the benefit of reserve currencies is typically that you get low rates. The negative is that you get trade imbalance. Now, all of that exists within reason until recently, and 4% deficit spending seemed to be that reasonable level, right? So that is until the last 3 years, which reached 5.4% deficits, 6.2%, and 6.4% deficits, respectively. So the consequence of that is reflected in the credit standing of the US relative to the rest of the world. So while technically there is no credit risk in a US government bond because of the government's unlimited ability to tax, print, borrow, spend, the more indebted that we become, the more our credit begins to be called into question. So that's reflected in something called the term premium, which can be seen here on the right. So now term premium is not only creditworthiness and represents the rate of long-term government bonds compared to short-term government bonds, right? So there's many factors that influence term premium. An additional one being long-term inflation rates, along with that quasi credit premium. So as the Fed cut rates last fall, we can see here that the term premium increased meaningfully. It's not something that you would expect, likely due to the increased inflation expectations, but also a reflection of our accumulation of debt via deficit spending, i.e., we'd become less creditworthy because of our debt levels and fiscal path were now a meaningfully greater credit risk. But since then, the term premium has actually declined in 2025 as future government spending is expected to decline even amidst some increased inflation pressure from tariffs. Now, while prudent in the long term to get our fiscal house in order, it does come with some cost in terms of reduced economic output in the short term, since government spending is, of course, part of GDP. The relationship isn't exactly linear, as there's some positive offsets that are gained by business from government spending cuts, but net, though, the reduction in government spending in the short term is a bit of a negative. Now, the final item of note within the early goings of the Trump 47 presidency is trade, specifically tariffs. So when a tariff is placed, it's typically collected by a nation's customs authority and paid at least procedurally by the importer. So who bears the ultimate cost of the tariff depends, as there are really several outcomes that occur because of the tariff, right? So the first potential outcome in a tariff scenario is that the importer, expecting the tariff, can negotiate that into the price charged by the export business, right? So in industries with high elasticity of demand, or one where price changes impact quantity demanded greatly, at least some concessions are really likely. In other industries where demand is highly inelastic, the cost must be either absorbed by the importer or passed to the consumer. Now, the goal is to have either the foreign nation accept a lower price for the product, absorbing the costs themselves to remain competitive, or to have consumers find a substitute good. But that's not always the case, of course. So the economic impact to the US may be increased prices, reduced profits, or nothing at all if the costs are absorbed by the exporter or if the consumer buys an American product. Now, President Trump's Wednesday announcement of reciprocal tariffs really sent some shockwaves through markets, mainly because of two factors. So I want to spend just a minute on those two factors. First, in the panel to the right, we can see that the most favored nation's average tariff rate in blue compared to the Trump tariff announcement last week, right? So the immediate takeaway was that Trump's announcement was disproportionately larger than what had been previously reported because of the quote unquote non-tariff trade barriers that were being included in President Trump's numbers, right? So this larger number was a bit of a surprise to markets. Now, the second issue with tariffs in general, at least in the short term, is confidence, right? So there was a good example of this recently that was used in GMO's quarterly letter, if any of you saw that. So if they used an example about copper mining, right? So copper is one of the tariffed items. And when you tariff something, you actually hope to reshore that production. Well, to increase domestic copper production involves developing new mines. That takes a decade. So if you're a copper miner, how confident are you that the tariffs and the new demand will remain in place a decade from now, right? You're probably not very confident. So in the near term, this lack of confidence by business causes them to postpone long-term spending plans, reducing capex, right? So this has negative implications for economic growth as well, at least in the short term. The other thing it does, which matters greatly for the near term, is that the market price of any asset is determined by discounting future earnings to a present value. Um, in uncertain times and in most predictable in certain times and in the most predictable times, that's still a projection, right? It involves some amount of unpredictability, right? When things are certain, it's reflected by the market by assigning high multiples to earnings projection when this confidence in earnings and the outcome is high, right? That was the case of what we saw just a few months ago. Now, the greatest impact to tariffs in the short term is that the market has a very poor understanding of what earnings will be, and even worse understandings of what multiple to perhaps assign to this. So to rectify this, um, we're actually going to need to see a series of trade deals, or simply give this the benefit of time for earnings to really kind of prove themselves in a new world of tariffs. And then finally, where the rubber meets the road, as they say, is in financial conditions. So on this slide, we're showing the Bloomberg Financial Conditions Index, which suggests exactly this point on policy restriction. So as a brief bit of background, the Bloomberg U.S. Financial Conditions Index is a statistical measure. It's a Z-score, tracking the overall level of financial stress in the U.S. money, bond, and equity markets to help assess how loose or restrictive the financial system is across measures that extend well beyond what the Fed is doing, and reaches into things like the equity market and how tight credit spreads might be. So high points for your reference indicate loose financial conditions, and low points indicate tight financial conditions. As recently as a year ago, March of 2024, financial conditions were about one standard deviation loose, meaning on balance, we were stimulating growth through the combination of credit markets, rates, and equity markets. Really kind of an odd thing to see, as the Fed was really worried about inflation at the time. So this has changed, though, rather abruptly in 2025, with financial conditions now reflecting one standard deviation of tightness. And I want to point out, you notice the rate of change on this is something especially to be especially mindful of, especially in a credit-based economy like ours. So let's shift gears and spend just a minute or two on fixed income markets. Jumping into fixed income markets, first quarter was a good one for fixed income investors, as concerns over economic policy and tariffs shifted the prevailing narrative from inflation to economic concerns, right? So as a result, expected economic output declined, and the probability of Fed rate cuts increased, with the market now expecting around 5 rate cuts in 2025. So as a result of that, the the Bloomberg Ag, I should say, gained 2.78% for the first quarter, placing first quarter results actually in the top third of all quarterly outcomes for bonds over the last 50 years. Rates, of course, were the primary driver, as evidenced by the fact that treasuries were the leading domestic fixed income asset at just shy of a 3% gain, 2.92%, bested only by local currency emerging market debt, which got additional contributions from the weakening US dollar. Kind of a bit of an irony, honestly, given that many were calling for dollar strengthening. In fact, parity versus the euro just a few months ago. Investment grade credit gained 2.36% on the period, but suffered due to lower duration and some modest spread widening to end the marking period, which that was actually more prevalent in high yield bond space, and is reflected in that 1% gain for high yield bonds. Now, for perspective, 1% is actually below the coupon rate, meaning that prices actually fell for high yield bonds during this period. So the lone black mark for the period was in muni bond space, which declined 22 basis points. At least part of that due to the seasonal effect of wealthy individuals in high tax states selling bonds to pay taxes, as well as some concern about the muni bond tax advantage status under the new administration. So now, even with those gains in mind, fixed income markets have been kind of tough to own for investors over the past few years, with many calling into question the validity of owning bonds at all. So while we disagree with that notion, especially if the argument leads to owning a greater proportion of stocks, the criticism, at least over the last few years, is very valid, with max drawdowns for investment grade space approaching or even exceeding 20%, and correlations to stocks increasing at times when diversification was needed most. Now, while that correlation increase is and was unusual, it does happen when inflation is the driver, because neither stocks nor bonds do well in environments of elevated inflation, as we learned just a couple of years ago. Now, on the return side, the cause of this, which is often the case with most assets that struggle, was high valuations reflected in low bond yields, right? Creating an element of being priced to perfection, right? That perfection was underscored by the assumption that inflation and interest rates would continue to remain at post-financial crisis levels indefinitely. When that assumption proved to be false, much like we're seeing with equities today, especially regarding growth stocks and assumed growth rates of earnings, bonds needed to reprice in that environment, right? And the benefit of that repricing has now resulted in higher yields, which has actually helped investors to claw back nearly 2/3 of those losses over the last few years, as is the case with the Bloomberg Ag. So where has that left us? This slide shows fixed income valuations by segment on the left. Here, high points represent good valuations, while low points correspond to poor valuations. As we can see, both high yield and investment grade bonds, because of their narrow credit spreads, present pretty poor return opportunities relative to their risk, with mortgages being just slightly below average. The opposite is the case in treasury space, with return opportunities across the spectrum of the curve falling in that 77th to 86th percentile of return opportunities over the past 20 years, or kind of said differently, in the best 14 to 23% of environments that we've seen in that period. So what does this mean more specifically? The right panel quantifies this in terms of return expected on the Bloomberg Ag. First, beginning period yield is a great predictor of future 6-year returns. We could see this via the high correlation between lagged returns and today's yields, as well as the overlapping nature of the orange and blue lines. So today, based on this, we should expect broad bond market returns of around 4 to 5%. 4.5% is the single point estimate here for the next 6 years. The other takeaway really pertains to cash, which we've heard many suggest should be the replacement for bonds in portfolios. Since 1977, there's only been one 6-year period where cash has actually managed to outperform bonds. So despite really the near-term results, the poor near-term results of bonds, future returns should be solid around that 4 to 5% range, and correlations other than in inflationary spikes should return to normal, as that we're actually kind of witnessing right now. So the final two slides I'll address are on credit and on EM debt. So here we're showing the high yield bond index option adjusted spread in dark blue, which corresponds to the left axis. As we can see, high yield bonds traded a spread at the end of the quarter of around 345 basis points over treasury yields, versus an average of close to 5%. Now, if we move forward to just this past Friday, that's gapped out a bit to about 427 basis points. So the interpretation here is a below average reward being offered for the risk of investing in high yield bonds versus its history. Since high yield is an economically sensitive asset and carries a bit of an equity beta, it's therefore not really surprising that spreads are really widening during this recent turmoil. Um, but that said, there's still really a pretty wide disconnect between the risk being accounted for with spreads of 427 basis points and what both equities and broad fixed income markets are telegraphing about economic risk. In our view, spreads need to move out 200 basis points plus from here to really present a somewhat attractive return opportunity for the risk in this asset class. And then the final slide before I turn over to Ryan is on emerging markets local currency debt. After a strong year in 2023, EM debt was not able to carry that over, declining by about 2% in 2024. Much of that due to the strengthening dollar. So that's shown here in the set of bars to the right that breaks down the sources of return for emerging markets debt. In 2024, income from the bonds contributed positive 566 basis points. Bond prices declined a tick or two, 35 basis points, but the real drag was the currency, with the dollar strengthening, subtracting about 7.5% and leaving the loss for the year. So thus far in 2025, that's reversed, and you could see that on the left, with the dollar weakening contributing 2% and adding to returns, resulting in that 4.1% gain that we saw and making it the leading fixed income performer thus far in 2025. So given that the EM basket of currencies remains undervalued, we consider this to be really a major tailwind and one of the primary reasons we are high on this asset for 2025 and beyond. So that's going to bring me to the end of my section. I'd now like to turn it over to Ryan to discuss equities and real assets. Ryan?
Yeah, great. So thanks, Mike. So equity struggled throughout much of 2025's first quarter as mega cap growth stocks really led the market lower. And this was largely driven by concerns over a couple of things. So one is tariffs. And two is going to be waning sentiment at both the consumer and the business level, all of which is really starting to call into question that whole American exceptionalism story. And this was particularly evident in the performance of the Mag 7, which isn't shown on this chart, but they fell by nearly 16% on the quarter. And for a brief time, they actually entered a technical bear market in mid-March. And a technical bear market is just a 20% decline from your most recent peak. Now, value stocks, although they did take a step back in March, they generally weathered the storm pretty well. So they produced a gain of 2.14% in Q1, and they actually outperformed their growth counterparts in the quarter by more than 12%. If we step outside of the U.S., non-U.S. stocks, they were really the clear winner on the quarter. This followed up a pretty difficult 2024 that was largely influenced by that near historic strengthening that we saw in the U.S. dollar in the final quarter of the year. And really, unlike the U.S., where the message at home was austerity via cuts to deficit spending and the DOGE initiative, a much more stimulative and accommodative tone came out of Europe and China. And this led to gains of 6.86% for the MSCI EFA index in dollar terms. We saw double-digit gains for the value side of the market, which was up 11.56. And then emerging markets turned in a return just shy of 3%, which was really fueled by strong Chinese equity markets. And then also, similar to the whole EMD story, the dollar here provided a really nice overdue boost to developed markets returns as it weakened during the quarter by nearly 4% versus that EFA basket of currencies. And then lastly, we have broad basket commodities. They were one of the big outperformers on the quarter, positive by almost 9%. And gains here were largely driven by precious metals prices, with gold ending March at an all-time high. So just to dive a little bit deeper into performance, the story last year and so far in 2025 is really that U.S. equity markets have pretty much lived or died by the performance of the Magnificent Seven stocks. So if we look back to last year, we had the average Mag 7 name up just over 60% versus under 12% for the other components of the S&P 500. And as a result, they accounted for more than half of the index's total return. Now, fast forward to Q1, and we see pretty much the opposite story. So for the quarter, names in the Mag 7 were down on average 15% versus basically a flat return for what's referred to as the S&P 493. And then when you look at the performance attribution, the Mag 7 names, they accounted for essentially the entire loss within the S&P 500 in Q1, while the S&P 493 actually had a slight positive contribution. And just a quick note on the math here. So that lower pane, we're just looking at the simple average performance, while the top pane is actual performance attribution. So that's going to take into account the weight of each stock in the index. So that's how you end up with that slightly negative average return for the 493, but also a positive contribution on the quarter. So like I mentioned already, we saw a sell-off in U.S. growth stocks and pretty sizable outperformance for non-U.S. value stocks in Q1. And I guess the question is, where does this leave us from a valuations standpoint? And long story short, it really hasn't changed that dramatically, if at all. So here we have valuation data that's going back just about 30 years, and we're using price to trend line earnings, because what it does is it allows us to look at some of those EM asset classes back to 1997. And essentially what price to trend earnings is, it's just like a CAPE ratio, in that it's going to help us smooth out or normalize an index's earnings stream. But what you're going to see here is that despite that sell-off, growth stocks are still really pricey. So if we were to percentile rank the valuations for all these assets going back to 1997, we're going to see that the large growth asset class falls into the 90th percentile, which means they've only been more expensive 10% of the time. And those periods when they were more expensive, they're going to coincide with the run up to the technology bubble back in the late 1990s, early 2000s, and then those highs that we saw in late 2021, right before 2022 sell-off. Now, non-US stocks, much different story. EM and EM value stocks are about as cheap as they have been in the last 30 years or so. And then international value stocks have only been cheaper about 22% of the time. So really attractive from an absolute standpoint. But what about a relative basis? Because this is really what's most important to us. So when we think about asset allocation decisions, everything we do is going to be based on relative decisions. So where do valuations look most attractive between these major asset classes, and then subsequently, which are going to be poised to outperform over the next market cycle, and where do we want to spend our risk budget? Well, I think there's a number of really attractive opportunities here. So first, if we look within the U.S., value continues to look like a standout opportunity. And this really goes back to something we discussed on last quarter's call. So although earnings growth has been really strong for growth stocks over the last decade or so, a lot of their relative outperformance was actually fueled by multiple expansion. So if you were to do a decomposition of their returns, multiple expansion contributed about 5% per year over the last decade. And this is how we get to that 90th percentile in terms of absolute valuations. And then outside of the US, EM and EFA value stocks also look attractive relative to their U.S. peers. In fact, they're about as cheap as they have been in the last 30 years. And this is really one of the factors that is kind of helping to fuel that recent outperformance, with those higher valuation names selling off during this period of market volatility where we've been experiencing. Now, to kind of shift gears on the next slide, I want to touch on something a little bit more fundamental. So on that front, let's take a look at earnings expectations, which have been getting revised down over the last few months. And what we're looking at here, so these are Bloomberg consensus estimates for the next 3 calendar years for a number of key asset classes. And I want to point out a really important trend. So when you look at 2025, growth stocks and U.S. stocks broadly, still expected to outgrow the rest of the world's equity markets. However, at this point, that should generally be priced into current valuation levels. However, when you start to step out into the future, you're going to see that gap starts to narrow pretty dramatically, which really speaks to that kind of waning optimism around the whole U.S. exceptionalism and U.S. tech leading the way story. And a lot of these asset classes that have been unloved over the last couple of years are actually expected to close that gap to U.S. stocks, and in the case of emerging markets, actually outpace their U.S. peers over the next few years. So thinking as a tactical asset allocator, I think the question here becomes, becomes, where do you position your portfolios? Do you purchase stocks at historic valuations whose earnings dominance is expected to erode over the next few years, or instead shift your portfolio to assets that in a few years are going to grow roughly on par with US markets, but today trade at a fraction of the price? And being contrarian, I think the answer is pretty clear, and you're going to see that in practice when we touch on some portfolio positioning towards the latter end of the presentation here. So just to kind of shift gears a little bit, step outside of the US, I wanted to dive a little bit deeper into what's occurred across global equity markets in Q1. And I alluded to this earlier, but it was really a strong quarter, not just relative to US stocks, but on an absolute basis as well. So although we had US stocks down just over 4% after that pretty difficult period in March, non-US stocks were notably higher. And in the case of non-US value in China, they were actually higher by double digits. So just to kind of take a look at China first. So Chinese equities have pulled pretty close to a near 180 over the last 6 months or so. So it started last September with the announcement of their commitment to some fresh stimulus measures, and then got accelerated earlier this year with the announcement of the DeepSeek AI model, which really helped to breathe some life into their ailing tech sector. Now, there's clearly more that we're going to need to see in terms of solid steps on the proposed stimulus measures, but it does appear as though they are moving in the right direction. And additionally, from a valuation standpoint, after nearly a decade of underperformance, they do have a nice little valuation tailwind at their back as well. Now, EFA value equities, they were largely propelled higher by Europe. So this is another region where valuations look really attractive compared to pricey US stocks. So here the story, largely new investment in government spending, which was announced out of Germany. So this was primarily done in an effort to address some of the Trump administration's new policy. And the goal here is really to become more self-reliant in terms of defense and technology. But I think a key driver of why this is so important, it relates to deficit spending, something that Mike touched on already. So here what we're looking at is the comparison between the US and Germany in terms of budget deficit or surplus as a percentage of GDP. And there's really two observations I want to make here. So the first relates to the relative responses to crises over the last 15 years or so. And what you're going to see is that the spending out of Germany, and here we're using them as basically a proxy for the European Union, it's really been dwarfed by what occurred in the US. And I think the two periods that couldn't be more clear are during the GFC, so back in that 2008, 2009 timeframe, and then the COVID-19 pandemic. So during the GFC, we saw the US running a deficit of near 10% versus Germany at just around 4%. And then during COVID, we see a deficit of near 15% versus, again, just about 4% for Germany. And this has really helped to propel the US economy and stocks higher on a relative basis over the last decade or so. But it's also the cause of the sticky situation that we've got ourselves in today in terms of our budget deficit, as well as the high valuations that we're experiencing here in the US. And then that brings me to point two. As we look ahead, the US is essentially looking to do what Europe did following the European debt crisis in the early 2010s, and that's to impose austerity measures. And while we haven't explicitly heard that term out of the administration, cutting government spending, cutting out waste is essentially austerity. And Treasury Secretary Bessent has even stated on multiple occasions that his goal is to shrink our budget deficit from 6 to 3%. Now, Germany, on the other hand, has explicitly announced plans to impose anti-austerity measures in terms of new investments in defense, infrastructure, technology. And as we look ahead, this divergence in fiscal policy does have the possibility to close that relative gap in both terms of economic growth and corporate earnings, which is really starting to become reflected in estimates over the coming years. And it helps to explain some of that newfound optimism that we've seen in European stocks, at least prior to that tariff news that we received last week. And then lastly, there's the dollar. So this has been a massive headwind for non-U.S. assets, not over just the near term, but over much of the last decade. So if we were to look at the difference in terms of local currency returns and dollar returns coming into the start of 2025, dollar strength had detracted roughly 200 basis points per year from U.S. investors in developed markets equities and nearly 250 basis points in EM equity returns. That said, though, we have seen a pretty meaningful reversal thus far in 2025. We've seen the Bloomberg Dollar Index decline by more than 3%, despite concerns over Trump's tariff announcements and the potential for a global trade war. Now, I know this is just a short-term reversal, but regardless of what metric you look at, the dollar still does appear pretty significantly overvalued compared to both developed and emerging markets currencies, which does add potentially another tailwind to non-U.S. asset returns as we look out over the next market cycle. So just to touch on some non-traditional assets. So I want to go ahead and start with commodities. With the exception of last week or so, off to a really good start in 2025. And although they have given back some of their gains over the last week, this is mainly due to a decline in oil prices. They are still well ahead of the S&P 500 on a year-to-date basis through yesterday. But focusing more specifically on last quarter, we saw the Bloomberg Commodity Index rise just shy of 9%, making it a top-performing risk asset. And performance here was largely driven by two components. So nat gas rose by more than 13%. This is driven by high demand from a colder than expected winter and supply constraints. But it was really gold and most precious metals that were really the driver of that strong return for broad basket commodities. So gold prices ended the quarter at a fresh all-time high, gaining 19% in just the first 3 months of the year. And this was really fueled by two things. So first, just from a purely fundamental standpoint, there has been a good deal of central bank buying, which has fueled demand. And then from a more psychological perspective, gold does tend to be viewed as a safe haven asset. And with concerns about potentially the fiscal health of the U.S., which Mike referenced when we were talking about term premium, and then uncertainty over tariffs, we have seen investors flock to this as a kind of a safety trade. But despite such strong returns, and we'll see this in a slide or two, we do still have a pretty positive outlook for the asset class, not just for its potential diversification benefit, but commodities do continue to look attractive versus U.S. equities when we think about it from a valuation perspective, with U.S. equities still priced to near perfection despite that recent sell-off. And then looking at closed-end funds. So closed-end funds had a great 2024, started off 2025 on some pretty strong footing. So discounts have come in pretty much across the board, with the biggest moves coming in international equities, where the average discount shrunk by 400 basis points on the quarter. And then within the muni bonds, we saw discounts contract by about 200 basis points. And despite this, both munis and non-US equities continue to look pretty attractive. Taxable bonds, a bit of a different story. So here, discounts are well within their long-term average, and despite spreads widening in March, discounts did actually come in during the quarter. So pretty pricey, some select opportunities, but versus the long-term average, looking pretty richly valued. Now, as we look ahead, the recent market volatility that we've seen over the last week or so is starting to create some opportunities across the closed-end fund spectrum. Remember, we approach the space tactically, so we'll own ETFs when discounts aren't attractive, which did help us provide a good deal of downside protection throughout last week or so compared to just a simple buy and hold strategy. However, in just the last couple of days, we have seen taxable bond discounts gap out by nearly 400 basis points and munis jump out by about 200 basis points. So if we do see this type of volatility continue, it could create some really attractive entry points into some of these funds that had looked pretty richly valued coming into the quarter. And then lastly, just to tie all this together, let's walk through our asset class return forecasts and some strategy positioning. So starting with our long-term return expectations, the order here hasn't changed, but we have seen some marginal improvements in U.S. Equity market expectations. Reason being, with a near 10% sell-off in growth stocks, this has helped to improve the overvaluation story. Although, as we saw earlier, both large growth and broad U.S. equities still around the 90th percentile in terms of historical valuation levels. And as such, you're going to see our expectation for growth stocks that's moved up to 2.1% on an annual basis over the next decade, and then large caps has moved out to 3.6%. So an improvement, but still well below what investors have experienced historically. Then if we dig a little bit deeper into the U.S., so value stocks, here we have expectations of around 5% per year over the next decade. So clear improvement over the growth peers. And then we have small caps, which are slightly higher than U.S. value stocks, but this does come with significantly more volatility. So there may be an opportunity here at some point, especially if they continue down that current path, markets continue to be volatile. We just don't think we're there just yet. And then we've got our standout non-U.S. equities on the far right with double-digit returns. And this really comes despite that strong performance that we saw in Q1. And the big driver of this differential is kind of what we talked about on some of the previous slides, primarily valuations being cheap and then getting that tailwind from the currency, both of which do favor non-U.S. stocks over the long term. And then next, just to quickly touch on this. So this is an interesting chart we've shown a few times now, which measures what we refer to as diversification alpha. So this is essentially the potential benefit that owning a diversified portfolio could create for investors versus owning just a simple 60-40 portfolio. And for the sake of time, I'm not going to get into the weeds on how this is all constructed, but if you are curious, please feel free to reach out to a member of our advisor services team, and they're happy to take as deep a dive as you'd like. But the big takeaway of this slide is that given the current low potential returns for U.S. stocks, from our viewpoint, it is essentially one of the most opportune times in about 20 years to consider owning assets outside of just U.S. large caps and to build a truly diversified portfolio. And at least in the short term, investors have seen a clear benefit to adopting this type of strategy. And then lastly, all this just directly translates into our strategy positioning. So we've got a pretty sizable underweight to U.S. stocks. And within the U.S., our most meaningful tactical position is going to be an overweight to U.S. value, with that value positioning being largely focused on attractively valued, deeper value, higher quality names. Outside of the U.S., we have meaningful overweights to both international and emerging markets value, as well as an out-of-benchmark position in commodities, relatively unchanged from prior quarters. And then on the fixed income side of the equation, got a small underweight to duration and pretty neutral sector exposure. And then consistent with what Mike discussed in his section, no exposure to high yield. Spreads here are still pretty tight despite gapping out a little bit lately. And then lastly, we've got an out-of-benchmark position in EM local bonds. This is an asset that's got the potential to benefit from a pretty attractive positive carry over U.S. bonds, as well as continued headwinds for the dollar. So just a final thought, where might we see some changes? I would say two areas. So one is on the fixed income side of the portfolio. We're getting close to where it might make sense to move a little bit more exposure to the belly of the curve, with the 2 to 10 year slope sitting around 40 basis points. We're also keeping an eye on credit spreads for both investment grade and high yield bonds, but it is still a bit early given you've gapped out, but you're still well inside your long-term historic average. And then on the equity side of the portfolio, it's really being contrarian and thinking about how we might position for a market bottom if tariff uncertainty continues to weigh on markets, continues to create this volatility. And that type of positioning would be in cyclically sensitive assets like higher beta small caps and REITs. But like credit, we think it's probably still a little bit early here, given the level of uncertainty and the volatility that's currently baked into markets. So with that concludes all of our prepared remarks. Pete, why don't we go ahead and check the chat box to see if we have any questions.
I do want to remind everyone that if you wanted to submit a question in real time, please do use the Q&A option in your user dashboard. We'll start with a few questions that were submitted prior to the webcast. First one being, is a recession looking more likely in 2025?
So Ryan, I could take this one.
Yeah, go ahead.
So the short and right to the point answer is I think so. Yes. So I base that on the two biggest factors in my opinion are confidence and being priced to perfection. Kind of like I mentioned earlier in my remarks, right? So when you're priced to perfection, there could be any one of 100 different things that can cause a correction. yet to continue to advance amidst really lofty expectations, you need a really perfect set of scenarios and a perfect set of results to that, right? So that's what we kind of came into the year looking like at roughly 34x on a CAPE ratio basis. The decline that we've had so far, regardless of the cause, is a negative wealth effect, right? Which on top of any delayed consumption due to tariffs, cuts from Doge, reduced or a less productive labor force due to immigration, right? There's just a lot of downward pressure at the moment, right? And we saw that on the financial conditions slide. Conditions are actually quite tight at the moment. Now, the second issue is confidence, right? And it's that corresponds directly to CapEx. So when you study recessions, everyone worries about the consumer because the consumer's 2/3 of GDP, right? However, when you look at downturns, there's only so much consumption can change, right? They have basic necessities, right? So it's business spending that usually tips you into recession, right? So if you're a CEO and you have to decide on a large long-term capital investment that will either benefit from reshoring operations to avoid tariffs or really any other large investment that may be impacted by tariffs or the absence of tariffs, are you really going to make that decision right now? Right? We don't know that tariffs will be here next week, not to mention 10 years from now. So to me, those are really kind of the likely sources of a recession if one is forthcoming. And I think the risk has certainly increased in the near term, even if there are some benefits from all of this in the longer term, right? Not all of this is permanently bad.
Thanks, Mike. I'm going to follow up with another question that we received. If we do see an economic slowdown and market volatility, are there any asset classes that you consider moving to?
Yeah, Mike, I can take that one because I kind of alluded to that in one of my
Sure.
last slides there. Yes, this is a bit of a kind of a catch-22 question because you need to anticipate the recession before everyone else does, and you really need to be there first. So once the evidence of the recession emerges, those assets have already moved in anticipation of that event, and you're basically too late. So I think a good example of that's treasuries. If your expectation was a steep recession coming later this year, you'd want to buy treasuries today because it's too late to capture those outsized gains after rates have already moved down. So I guess that said, we wouldn't move our portfolios in the expected manner to seek safety in the event of a recession. At the point when there is blood in the streets, which is something that Warren Buffett likes to say, we'd be looking for cheap assets that would do well in the recovery, which is kind of what I alluded to a few minutes ago. And just thinking about kind of what those assets would be, they're essentially the opposite of safe haven assets like treasuries. We'd be thinking about corporate credit, both investment grade and high yield, because spreads would likely look much more attractive then than they do today. And then on the equity front, you'd want to position in the most economically sensitive assets you can find. And two that specifically come to mind are higher beta small caps and REITs. So both of those should perform exceptionally well coming out of a recession. I guess the big risk here is just really being too early because all four of the assets that I just kind of walked through are also likely to be underperformers on the way down. So all of this is really about anticipating where the puck is going rather than just being reactionary.
Thanks, Ryan. I just want to remind everyone that if you do have a question, please do submit it through the Q&A function in your user dashboard. We do have one additional question so far. Can you comment in a little more detail about the extreme volatility we've seen over the last few days?
Yeah, Mike, I can grab that one as well.
Sure.
If that works.
Sure.
Yeah, so just to put the recent volatility into context, so last week was the worst week we've seen in markets really since March of 2020 during the onset of the COVID-19 pandemic. So clearly an unusual and extreme event. And just to borrow a stat from Mike's opening remarks, that 33 or so day drawdown in the S&P, it corresponds to a more than 3 standard deviation events. So from a historical perspective, it occurs less than 1% of the time. And I think this really speaks to that massive spike that we've seen in the VIX index. So the VIX moved from a low of, I think it was around 17 in late March and peaked around 47 yesterday. And if you were to go back 25 years, there's really only 2 periods that have actually exceeded this. So you've got the financial crisis in 2008, and then you have the COVID-19 pandemic in 2020. And one other period of note is we were basically on par with the volatility that we saw yesterday, which occurred during the European debt crisis back in the early 2010s. You were around 47, 48. Now, for volatility to remain elevated or spike from here, you would need to see conditions worsen, which could come in the form of a couple things. So first, if retaliation from our trade partners, and with the exception of China, it seems like we are moving towards trade deals more than an all-out trade war, that could clearly increase volatility. So at least as it stands today, the risk here seems remote but not impossible. And then I think second, probably most importantly, is some type of spillover effect. And these are kind of things that have caused prior crises, spillover effects that lead to some type of systemic risk to the system. And at this point, we don't really see any of that risk materializing. So most of the assets or institutions that would be at risk from something like this, a systemic event, are actually being helped by the current movements in the market. Because although equities have declined pretty substantially in just a short period of time, so have interest rates, which helps everything from banks' balance sheets to commercial mortgages, as well as the U.S. housing market, because a lower 10-year likely means declining mortgage rates. So I guess kind of just to sum up, from here, it's probably unlikely to expect volatility to increase substantially, but by all means, it could remain elevated until we do get some more clarification on the whole tariff and trade war front.
Thanks, Ryan. We don't have any additional questions, so this will conclude our Quarterly Market Insights webcast for today. Please be on the lookout for your invitation to our upcoming TICE and TICE Alpha Opportunities Strategy Update webcast, which is going to be held on April 17th at noon Eastern Time. As a reminder, the replay of this webcast will be available on our YouTube channel. We encourage you to subscribe to our channel to receive notifications of new video content, including Markets in a Minute and Mic'd Up with iCM. I want to also encourage everyone to check out our Advisor Content Center as an outlet for great strategy-specific content. Thank you for joining us today.